S&P 500 at a critical level. Nasdaq makes a new year-to-date closing high and is 3% away from all-time highs. Why the Russell 2000 is the index to watch in 2024. What scared the Treasury market? The VIX breaks a critical level. The dollar falling continues to drive equity prices higher. One country in particular is benefiting greatly. What stock is benefiting more from NVIDIA's record earnings than NVIDIA? What smart money and dumb money are telling us? How YPF is up 65% in 4 days and why it's just beginning. We have a ton to go over. Let's get to it. Hey everybody, welcome back. So we have not 1, 2, 3, 4 new closing highs in a week, which is exactly what you want to see. Really what we really want to do is not get over this higher high right in here. I think we're heading that way. It sure seems like it. We even grinded right over this little doji right here, and we seem to be pushing. There's some damage that's been done here, obviously, to the shorts, and I think we're seeing more of that right now. Let's just drop this right in the middle. I just want to show you this DTL, but we have a ton to go over, a veritable ton of information on what's going on in the percentage of stocks over certain moving averages, what it's meant in the past, what it's going to mean now. You have an entire country that's breaking out, and literally an entire country that's breaking out that we have to go over, especially the large caps. And we saw this huge change between NVIDIA and this other power player that's starting to pop, and we started to see that money flow change. We have to get into that too. So there's a lot going on out, and let's discuss it. But we just have to accept that we're at this DTL, or downward trend line, and kind of understand what's next for us here. Well, first and foremost, I think we have all seen this, but we're going to just pop it in real quick and talk about it. We all know that this is a cup, and we've all been talking about this handle for some time. Now, whether or not you want to call that a handle, you're going to say, well, it's not deep enough to be a handle. I really don't care. I think you're splitting hairs at this point. It's there. It's clearly absolutely glaring. It looks just like the Nikkei if you look at the Nikkei. And the question is, what happens next? It's a great question. So the way that I always look at it is I want to look at my weekly indicators and just see what they're telling me. Number one, we're not even remotely overbought down here yet. We're not even close to overbought. And you can see very clearly what happens when you do get overbought and you roll back over. And that's what happened right here, but we're not seeing anything like that right now. We were over here and we were rolling back down, like you could actually see how you were here and you were rolling back down. That's going to give you pause. We're not getting that. We're not remotely getting that. What we're getting is we came to the 50, broke the 50, and now we're heading higher. And we're not even at that overbought section. So we have a long way to go before you're there and before you're even overbought. I mean, you can even make the argument that you're having a positive divergence here with this not even being over that yet. So I'm pointing up. If I was rolling over, it'd be a different story. I'm pointing up. So this is still setting up to have a pretty strong move. So looking at the RSI can certainly help us. Another thing I like to look at is just see what's going on with the MACD. Not so much that we have to act on it, but it's a good demarcation line to say the least. And we can see we came right to that zero line, bounced, and now we're getting a weekly cross again, and we like weekly crosses. Whether they're to the upside or downside, they at least give us an understanding of what's going on, but there's really nothing better for MACD, in my opinion, than getting to the zero line, rejecting, and setting up. Now, the other thing that we like to look at is rate of change, because that determines the velocity of this entire move via up or down. Now, in this chart, we're just going to also just pop in a 200-week moving averages just so you can see where we're at. And that's what this black line is, but you can also see how we have our head and shoulders, the break of the head and shoulders right into the DTL. So it's a little bit out of the frying pan into the fire. I mean, I guess it's a cup and handle, so we could probably use another analogy there that might be a little bit better. But see where the rate of change is down here, and then you start seeing how it's starting to pull up. So what we would look at is we would look right here, and we would see how that correlates to this move, and then we would see where we're at right now. And there's one thing that you would take away from this, because you would know that rate of change determines velocity. And understanding that, you would know that the velocity is going to be stronger now than it was on the last move. When you understand what these are, just like when we're going to dig into smart money, dumb money, when you start understanding what these are, you can utilize them. You can utilize them for what they're intended. And I think that's a really important distinction. So for us knowing that the velocity is going to increase, and this is telling us right now that the velocity is going to increase to the upside, we're going to look at the weekly charts and spend time on the weekly and get a larger picture here, because I think we need to look at the larger picture because what's going on with OPEC and some other things right now. But if we take a look at the NQ, I mean, this is really going to be same soup reheated on both charts. So I'm not going to spend a lot of time on that. What I'm going to talk about mostly is the laggard. But if you look at NQ, I mean, this is setting up to break out of these highs very clearly here. We already know where some of these sectors are. We're going to talk about some of those sectors and subsectors. But if we know that rate of change is here, we know that rate of change is greater than it is than when we were here, or then even for here, then we should have a very good understanding that the probability that we're going to break out over here is probably fairly good. Now, it doesn't mean you're going to do it on the first attempt, but we'd have to get up to here and then reject. I just don't see that happening, and I don't know really what that driving force is going to be. My driving force was the NVDA going to roll over, and we're going to talk about that and why it's might not even be the issue. Although today, at the time of filming this, I'm not really crazy about what they did, and we're going to have to address it. We're not going to really have an issue, but let's take off 200 for a moment right here and just talk about this on the weekly. So what's going on here? Well, RTY we're going to wind up drilling into on the daily, because I think that that's where we're going to get the most amount of attention, where we're really going to get into what we need to there, really dive into the details. But I always try to say when the metal meets the road, that I think it's when the rubber meets the road. I don't know where I came up with metal, but I'm just going to keep going. So, and I appreciate that I don't have to edit, and I appreciate your comments on that. So we're just going to keep rolling and just coming up with the content, which I think is way more important than my analogies and also from my metaphors. So I'll try to cut back on those, although some people tend to like them. So what's going on here? The rate of change is starting to roll over. I'm thinking of showing you the RSI next. So right here, the rate of change, we're popping over. We're already over the zero line. When was the last time we cut up over a zero line? It was right here. It was the last time that we cut over one. Okay, so we have not flipped the zero line since May, and we're starting to do that again. That led to a run. My personal opinion on this is that we have this really nice multi-year base, and I'm sure that you see this already, but we're just going to pop it in just so we can talk about it a little bit, and colors of them. And now look, so it's pretty glaring when you get into it, and I'm sure everybody can kind of, gets a sense of the up and the down. And I mean, it's pretty clear what's going on here, but what does it mean and what should we do about it? A couple things. I think you are silly. I'm going to change the colors over and over again. I mean, that is just crazy to be in that range that time. Now, what's important about this besides the fact that we changed the colors? Now, the amount of velocity on each one of those moves is getting tighter. And now that I get rid of the fancy colors for a moment, we'll get into it. What we have to talk about is the velocity is changing, okay? And I think that's extremely important. They're trying to get people out, in my opinion. They're doing the undercuts. So you see this undercut here to here, and then you don't go anywhere. So you have the undercut here to here, and then you don't go anywhere. Okay, here again to here, and then we don't go anywhere. All right, so they are purposely over and over again undercutting the lower low in the previous. Okay, here to here, here to here. Okay, over and over and over again. And what are they doing each time? They're getting to the same number over and over again. Why are they doing that? They're looking for stock. They're long-term looking for stock and testing levels. And there are people that look out that long-term. People will see this happen on a minute chart and assume that they don't do it on weeklies. They do. So now you know something new. So here we are, rate of change is popping over. This is what I really wanted to take a look here, and we look at what's going on. We are about to pop back over the 50 on the weekly. When was the last time we did that? Back here in May, same time as rate of change. These are significant levels, guys, and I would not sleep on them. These are leading indicators if you utilize them properly, and we're utilizing them properly and associating that there is a possible change. I'm wondering if it's going to be, let's get to the daily. I'll tell you what I think it might be, and you can always comment below on this, because I'm curious why people think we're still lagging, and we could talk about, oh, this stock's here, and this stock's there, and these stocks don't make money, and it's all the other stuff, and it's that these are regional banks. All right, but I'd really like to hear your comments on why you think it is. I think it's underperforming because the majority of these names are taxed, and I think people are taking tax on their regional banks, which is 15.9% of the Russell. That's what I think it is going into that. If that's the game, then that's what happened to technology in December 22. And January 23 was one of the best buying opportunities in a decade for large cap tech. I think we're setting up there, guys. I really do. Now, if we take a look at the Russell here, let's go to a plain chart for a minute, because I do want to spend some time on it. You break out, you have the push, you form the gravestone, undercut, but where can't you get? Now, you'll start seeing how all this stuff starts tying together. One of the things we like to do is just mark a 50% line and just see how we act on that 50% line. You couldn't even get down 50% on that bar. Matter of fact, it took you right into where a support line would be, and you still didn't break it. You form a doji, you pop over it, and then that's pretty much it, okay? So we know that we're not doing that. We know we're forming a flag. We know we couldn't get halfway down the bar. Then we come in and just overlay the simplest of daily indicators. And we're going to notice some really glaring habits that you haven't had in some time. Number one, let's just focus on a couple key things. What would we focus on first? Well, let's get rid of the 22 and let's get rid of the 12. And let's focus on the 55. You are above the 55 for the longest time since June, period. So let's just deal with that. This is the longest time that we've been above here for this period in time. Okay, that in and of itself is a big deal. The other thing is, since June, this is the longest that the RSI has been above. All right, it's the longest it's been above the 50. So there's another data point that's used the 12. When was the last time we had this level of trajectory on the 12? Has not been since June, since we had a long green bar up, then had some consolidation, and then went back to that 2000 level. Starting to look familiar. So then we would get into the 22 and say, well, what's going on there? Is that telling us anything? Yep. When was the last time that we pulled up over? That was June, right? So what I am, guys, is more than anything, I am a pattern trader. Okay, that is how I make the majority of my money, whether it is long-term, short-term, and of course I look at the macro, the fundamentals, and the technical analysis, and we're going to dive into all that today. But what are we really talking about here? What happened right before June? How many wicks are we going to get into this before we start breaking out again? And they flip this to what? Support. So I think there's a lot of glaring things that are going on right here, and I definitely think this is something that we should pay attention to. TNA, for example, this is something that I was in. They gave us the little wick, the shakeout, and then went sideways. What else is holding up? And no one's really talking about this, but we're doing quite well with this trade. We've actually doing, at this point, pretty exceptional with it. No one's talking about this anymore, that RK is literally setting up to challenge the June highs. And the only way that that's going to happen is when you get near the 52-week highs. So this is actually setting up to push going into the end of the year. I think that is pretty substantial. And it wouldn't be happening unless you're seeing some short covering in some major tech names. So we understand where we are, and we're starting to see the divergence. And the important thing that I want you to take away from this before I go any further is the following. You are seeing money flow into smaller cap names, and the leaders are already starting to maybe change, and we're going to discuss that. We know where we are with the RTY. We talk about the 10-year. The 10-year is the 10-year. 450 is the new 5%, right? We all see that. We all see this island here. We don't need to pretend that we don't see it. Why did we sell up the other day? Because Europe's PMI was up. Okay, it is what it is, guys. Nothing's going to be a straight line. We're grossly oversold here. What I'm really surprised about, besides the dollar, is, and we did talk about this the other day, that you could sell down, meaning the VIX actually could break. And that's really exactly what happened here. The VIX actually did break at that 13 level, which it has not done. So everyone was saying that, oh, we're definitely going to, if we hold here, well, that's definitely going to be it because we've been bouncing there all the time. Trends are trends until they're not. And that's why you always call them places of interest. And that's why you always look at things in terms of percentages instead of concrete brick walls. Like there's a high degree of probability that's going to hold. That doesn't mean that it's definitely going to hold, does it? Didn't. So that's something that we look at. And before we even get into some of the larger cap names and what's going on out there, I think we'd be remiss in not talking about the dollar. And this, not putting the most simplest of averages in again with 55 and how it's pointing down. And it is very clear that the dollar is going to get some deflationary pressure here. It's been getting that kind of pressure on it. The weaker dollar obviously helps the ES, and I think it's going to help another country even more so, which we will get into. But I do want to just focus again on some of the just bare minimums before we get into smart money, dumb money, which I think is really important tonight, more important than maybe some of the other topics. So one we're going to get into is going to be S5TH. And I want to do this before we get into smart money, dumb money. So what we want to focus on here is the following. Stocks above the 200-day moving average, S5TH. And this can be placed on what? This can be placed on TradingView. You can use this on TC2000. I think it works on a couple others as well. But TradingView you can literally look at. So this is percentage of stocks above the 200-day moving average. Well, what do we want to take from this? Well, what you would look is every time that we broke this level, September 1st, every time we got above here, June 6th, right? When you start looking at this March 31st, when you first get above these levels, January 5th, you're going to notice something pretty clearly. And I think that this is really important. Now, all these marks that I put on here, what I tend to see is I tend to see a rally. And I tend to see a rally after the pullback, but it happens later on down the line. So there are 4 times this year where we have done this. Let's talk about that before we go a little further. So there have been 4 times this year, let's go to the weekly, where on a weekly chart, we have been over 90 on stocks above the 20-day moving average, S5TW. There have been 4 times in 22 when we have gotten over 90. All those times are marked right here on the SPY. And I think this is important because what happens when this happens is we tend to go sideways. We don't tend to just fall apart. We tend to go sideways, at least for a week or two, digest, and then move higher. We're getting to that. So we may be undergoing some level of digestion, but there's something else that's happening right around that time. It's happening a little later. Now, after you get those 90 readings, once you get those 90 readings on the 20, what tends to happen is you start to get above 50 on the 200. So the last 3 times that happened, and we're already over here, but the last 3 times that happened in the past, let's call it 12 months, on the 20-day, where you are over 90, and that is, again, let me just give you these, because I know this is going to be a lot in a very short period of time. S5TW, every time you're over 90 on a weekly, because it's going to be a different number, that's where you are on the 50. So you have plenty of room there. You don't even have to worry on the 50. This is S5FI. You don't even have to worry until you're in the mid 90s on that one. So you have plenty of room there. But every time that you have a 90 on a weekly on that chart, you start seeing these 50s, you start seeing them hold. So every single one of those is followed by over 50 every single time. Now, if you look at that, they are giving us pretty much the most significant moves that we've had in the market. This is giving you this great move, this is giving you this one, and now we are here. What does this mean? This means that if you're going to use that data, because people have said in the comments, and I do appreciate the comments, I do appreciate you sharing, they'll say, all right, get to the point. This is all great. What does it mean? And I'm trying to get you to think, and I understand that, but at some point you're like, oh, please just get to the point. But the point being is we're probably setting up to go maybe sideways or grind a little bit before we set up another push. What I'm trying to figure out is, are we going to continue to see rotation? Because I think personally we're setting up to see rotation, not only in tech sectors, but I think we're setting up to see rotation in other asset classes in other countries. And I'm going to get to that. But first, let's take a look at smart money, dumb money. Now, one of the things we like to look at is dumb money, but we don't refer to this as dumb money. We refer to this as retail. And the reason we do is because it is retail and that's how it's calculated. We will go through dumb money and smart money today. We will show how they are calculated. People were referring to this as confidence in the comments, and I appreciate your comments because it lets me know where to go with it. In other words, if you don't fully grasp what this is, then we have to talk about what it really is. And so people get it. It's not just confidence in the sense of it's a fear and greed index. Far from it. It's people actually betting with their money. But again, we refer to dumb as retail. And one of the core things that we always like to do is we always look for patterns. Now, the one pattern that we see very clearly is anytime that we are over this level, we want to pay attention. Now, we're not going to take this into account again. And we know why, because we don't have $1.7 trillion in the market as a backstop. So what we would do is we would not utilize that. What we would do is we're going to look at what we have since they pulled their money out of the market. They referring to the Fed, and we can see right here the peak. Now, these peaks are a little more different. What do I mean by that? But you can see in here as well. And you're going to note something here, even with these over 7, and I'm going to refer to them as 70 just because I'm used to 70 when I see RSI. But what are we seeing here? What is actually happening here? Well, it's not just the over 7.7, we're going to say 70 again because it's easier for me, line. What does that mean? Does that mean that we automatically sell because retail is over exuberant? And that makes sense when the last guy's in. You know, when the last guy at the party hears how great the party is, by that time the party's ending, right? So that's what we're seeing here on a 3-year area. Now, what does that mean? I do want to look at over 0.7. I do want to pay attention to this. What I would notice is I would notice how this is acting. In other words, it's not just that you're over, it's when you roll and you go back down. So when the last person is done betting, that's when we start to have an issue. And that's what you're seeing here. In other words, when you start to roll over, that's when you really start to see an issue. The magnitude of the roll over is significantly greater when you're over this. And that's what you're seeing here. It will go on for a longer period of time when this happens. So when people are saying that dumb money is overbought or, geez, dumb money's really getting involved here, what they really should be looking at more than anything is not that. They should be looking at where you are in the context of this line and then saying, well, what we really need to see at this line is not just get to it, but we need to get over it and then see, are we going to get this where it just keeps going on for months? Or are we just going to get like a week and then roll back down? The answer is we don't know. What we do want to know is that when we get up to this level, and we want to look at over a 3-year period, we want to realize that we've only been here so if you mark them off, you've only been here 1, 2, we'll count this as 3, we'll count this as 4 because you never broke after it. You've only been up here 4 times in 3 years. So the probability that you're going to stay up here is not significant. And we would all agree to that. We would all agree that you've spent more time in this range. I mean, that's pretty clear, I think, to everybody, that you spent more time in this range than you're going to have spent, right? I mean, over than these 4 that are up here. So I do think that that's an important distinction, and it's certainly one that we want to make. And we just want to be cognizant of that. Like if you were saying, well, where'd you spend the majority of time? Well, below. So it does mean that when you get up here, eventually the party's going to end and we're going to have a period of consolidation. The question is when? Now, the other side of this is smart money, but we don't refer to this as smart money. We refer to this as institutions. And the reason that we do that is because that's really what it will refer. And we're going to show this in a second. But smart money is just that. It is institutional money, and that's how we want to view it. And we're going to notice some huge differentiations here that when they are maxed out, what do we notice? When they are maxed out, it is usually a bottom. Maxed out, a bottom. Say it one more time, bottom. So you're getting it. And what usually happens when they are maxed out, you start to see a kind of rally. When do they tend to buy? Well, this is where it gets really fascinating, at least for me anyway. But they tend to buy when you're overdone, when they are all in a position where they are pretty much exhausted. And so you're seeing a position of exhaustion here, a position of exhaustion here. That's really what we're looking for. Now, it doesn't always line up perfectly, and nothing ever does. My personal belief is that the dumb money is a better indicator of this, or retail to it. But when you see this, it's supposed to tell us where we may have bottomed. And are you really getting that kind of vibe from that? Not really, are you? So what else could we learn from this? Is this really where we're getting toppy? No, it's not. To me, it's not. It doesn't work the same way. Okay, how could we utilize this, and how could we use this more effectively? Well, we can understand what it is. We can understand that when they are completely exuberant, they being institutions, what happens? This is them being exuberant. When we see that, what are we getting? We're getting levels of exuberance. And then what are they doing from those levels of exuberance when you're over that 70 line? We're going to say it's 70 again, even though it's... So what does that tell us? It tells us the same thing, that when you are over that line, it tells you that you're putting a bottom in. Where the other way, it might tell us that we're putting a top in. And I think that's a really important distinction. This, we're going to say, oh, this is going to tell us that we're putting a top in. Well, is it? Because that took forever. Is this really telling you put a top in? Because 3 months later, here we are. So I wouldn't use it that way. And I know that people do. So I would just use it as I find it most effective. If you find some value in that, that's fine. For me, I'm not going to see it that way. I'm going to see it this way where, all right, I'm more interested in what happens when we break this level and then go higher. And so I would mark those levels off. We see something there that's worthy. And I'm going to say, no, I don't really see it. I see this as something that has value. I can see the value in this. I think there's value in understanding that. So I'm not going to say that this is not something that I'm going to pay attention to, but I'm going to say that over and marking a bottom is a much greater indicator. And even here, again, all you need to do is roll over. I like it better when you're over here, over the 70 line, but you don't need to be there. Now, this is what they usually do and how they usually show them. They show them together, and then they will obviously show dumb money in red or retail, and then smart money here. And then what you're getting is you're going to get a spread between these two. Now, the spread is interesting because the spread in and of itself, a level of interest where you could have a top. And usually if dumb money is up here and smart money is on the bottom, or institutions are on the bottom and retail is up here, well, that is currently doing what? That is marking a top, right? And then what happens when smart money is up top and dumb money is on the bottom? Well, that is marking a bottom when the spreads are this big, aren't they? And that's reflective in this. What they do is they put a spread together, and they just will show you very clearly at the top of the spread when they're over this line and rolling back down. You can see from here over, that is marking a bottom. And then when you are way underdone here, this combination is certainly marking a top. And I think that that is an important distinction to look at the spread. To me, the spread makes more sense than looking at just smart money at the bottom. It's the differentiation between the two. I have proprietary indicators, and I use differentiation between different metrics and then how they're scaling, and then I assign numerical valuations to them. I do find it helpful because it gives you a rating system. And so if you were looking at this, all right, so you're dropping, and this is where you're dropping, but you're not starting that turn yet, are you, right? You're dropping, but you're not starting that turn yet. So you're not getting that toppy action just yet. But what this is saying is it's saying that we are getting close. Now, one of the things that I heard about was that, well, this is just showing confidence. This does not show confidence. Well, maybe you could say it shows confidence in the bets, but let's look at how this is actually calculated and what they're using. So if we just take a second and go examples of smart money, and again, this is Sediment Trader, which is a service that I utilize. I have no affiliation with them whatsoever. They just provide a good service. Examples of smart money indicators include put calls, open interest ratios, commercial hedger positions in the equity index. Okay, that is pure institution, period. And it doesn't really get any clearer than that, that is institutional trading. And also what it's going to do is going to do some other things here that I think are important, but you're going to look at not index futures, but the current relationship between stocks and bonds, because it is who that has to worry about that positioning. It is pension funds that have to worry about that positioning. Now, they always say, in contrast to what smart money is doing, we want the opposite of what dumb money is doing. I don't feel that way. I feel that you should understand who's doing what and then where we are. I think there's something to the spread, but I don't feel that way. So I do think that we should look at some differentiations here. So as they're looking at one kind of put call up here, down here they're looking at equity only put call ratios on dumb money, which is very different than what they're doing here. They're looking at the flow into and out of RIDEX series of mutual funds. So they're looking at these, pretty juiced up ETFs and mutual funds, and they're looking at the flows down here to determine whether or not what dumb money is doing. Very different than what smart money would be doing, right? They're not going to do that. They're going to create their own kind of ETF. Then they're going to look at the small speculators equity index future contracts. And that's also going to help look at what's going on, because now up here you're looking at the small speculators equity index futures, and up here what are you looking at? Commercial hedger positions equity index futures. You're looking at two different size traders. Understanding these nuances, this is where the metal meets the rubber, or the rubber meets the road, or whatever analogy you want me to come up with. Bottom line with this is the differentiation factor that you want to pay attention. And understanding these nuances make all the difference when you're looking at these indicators and how to use them effectively. And everybody's going to use that data just a little bit different. Now, I want to spend some time on the usual suspects before we get into this one sector that is completely breaking out in this country that's completely breaking out as well. But I think we need to get into some of these usual suspects to kind of talk about what's going on under the hood. So if we take a look at Tesla, we're going to notice the most glaring thing in the world, that the 55 is just protecting us. Every time it looks like we're going to get over, we just get matumboed. At the same time, the 22 is curling up, the 12 is curling up. I use a 12, a 22, and a 55. You should use what you're comfortable with. The biggest takeaway that I have here, the more that I look at this and the more that this develops, that we have this gap down, then you have the island reversal, and since then, you have another breakaway island continuation. It's a pretty rare pattern, but we're not really doing anything with it just yet. But that doesn't mean that we're not going to do something with it. But we're just going to have to watch how this plays out. And candidly, I keep expecting it to break down, and it's not. Let's take a look at this on an even greater detail, because I thought this was absolutely glaring today. Really dive into this a little bit and spend some time with it. I'm going to take that 30 line, and I just want to move it up. I want to move it to that 31.58, you can see right here. And let's just look at this coming across and look at that level over and over again. Since you broke up, you have not been able to get through that. We watched this level repeatedly, and even today you couldn't get near it, and then you start bouncing up. Now, everybody's aware that I refer to these patterns as devil horns that are right here. We're all aware of that. Arrow. And I want to thank everybody for sharing these videos and commenting. It does help me greatly and know where to go with it. And I do get asked, hey, just go over the usual suspects so that we don't have to talk about it too much and we don't have to even comment on it. That allows you to comment on other things, which then builds the not only community and the channel, but I get the information out that you guys will find most pertinent, which is the whole purpose of doing that. If I'm looking at this level, we're holding. So I can say anything I want about the Cybertruck and how ridiculous it is that you can't even fit a bike in it, can't get up a mountain. I can just trash it. It doesn't matter what I think. And that's the whole thing. Check your ego at the door. 1, 2, 3, 4, 5. Count along with me. So you see where I'm going with this? We're not breaking. You're clearly wedged in here. Here you have the devil horns sticking up. You got your little devil face right in here. This is giving us something that is absolutely glaring, something that we should be paying attention to. And I think that if we do pay attention to this, that we'll do exceptionally well. I would not be long or short in between here. I don't think there's any edge whatsoever. I don't need to look at a weekly. You are wedged in between these two lines. So if I was you, what I would do is I would mark these two lines And if I wanted to be long, it would only be when the risk versus reward was about 2-to-1 after coming off of this. Short, about 2-to-1 coming off of that. That's really about it. That's really what you do with Tesla here. I know I'm going to be asked about it, so I do want to go through the usual suspects. Now, if we take a look at Microsoft, what I like about Microsoft more than anything is you had some really good news. This is from the private video and the private newsletter, but it's here, so we're going to go over it. And it's pretty much out at this point anyway. But the first adopter of the H200 new NVIDIA chip is going to be Microsoft. They already have their orders in. They're already saying, line me up for it. And I think that's very important, right? Because you're seeing somebody say, hey, we want this and get us in line. You did not see Amazon get in line. You did not see Google get in line in the same way, saying, hey, we want to be the first adopter of this. Now, Microsoft, it's not going up, it's not going down, but you hit new highs. I think if you're looking at a stock, the number one stock that Goldman is telling people to own for the next 5 years, so I think that in itself is telling, and I definitely think that that's something that we should be paying attention to. And I think it is something that we're paying attention to and doing a pretty good job of it. But as we go through, again, the suspects, as we call it, the top 7, nothing really to say here with Meta. You're just breaking out, you're running away, you want to get through these top levels, you're really looking at trying to get through 354, you're trying to push and get up there. But there's not a lot of rush to be in there. You take a look at Google. Is there really a rush to do this? No. But the XLC, which is where these names are, the XLC is out there hitting 52-week highs. So what's the driver? Well, for whatever reason, it's Netflix. And Netflix had resistance at 478. Now, for my purposes, today was not my day to go, you know what, I need more long cap exposure going into the weekend. I had different exposure in different areas, and it just wasn't something I was overly interested in. But take a look at how we're responding to this area, and I'm really going to drill into this so that you can see what I'm talking about. That's our resistance. And look at this on an hourly basis, and look at how you've been fighting it. And now you've kind of made a decision, haven't you? You have all 4 hours today, even though it was a short day, they're all over that level. So that is definitely something that I'm paying attention to, because we haven't done that. We didn't do it back here in July. So we're doing something different. And when we do something different, we want to pay attention to this. Look at this on a weekly. What we're looking to do is we're looking to flip that level. Top of this wick is going to take 482. Let's get an exact number there, 485. So your next level is 480. That ties right into major support. If that support flips to resistance now, and I think it will because we got through the 478, which was really difficult, then really the 510 level in the daily's next. But realistically, you're heading to the top of that open. That open is 520. So we'll leave that there at 520. So there is room for Netflix to push. And I think this is very telling. You have the pullback and then the rally. On top of that, take a look at this. We keep waiting for ROKU to pull back. And by we, I mean me. And it's just not. Now, what do we have? Well, let's go back to 22 to 23, and let's forget about the goofy times where we just had, we were competing with the Fed for houses. And let's just take a look at what's going on. We'll get rid of this, we'll drop it down, and we'll just mark the bottom. Now, if somebody was to show you this chart, say, oh, this is 2 years out. Are you thinking that is not going to go higher because you have this all the way over here, this nonsense, right? Where, again, you're competing with the Fed for assets? No. So you're not going to think, you shouldn't think that. So you have a 2-year base. I would really pay attention to this name. I'm not saying that I need a ROKU or that they're in huge demand, but something's going on here. I've got the 3-bar pattern, I've got the cross coming across, and I've got the breakout. So this is definitely something of interest. Now, let's talk about the 800-pound gorilla, which is NVIDIA. And we're seeing some signs that are, I won't say disconcerting because we did this in the past and then we just developed. But what we are seeing is starting to, I would like a breakout, not a breakdown. So first, you can see down here on the weekly and how you're breaking there, right? And that's definitely. Second, we can see here and how that is setting up too. Well, we know that this is a megaphone. We can see that megaphone. The issue that I'm having is we're not getting that. Now, what we had today does not make me feel, you had earnings. We had earnings on Wednesday. Actually, Tuesday night, we come in and Wednesday morning and we're down. We have the holiday. Friday, they come in and say AI chips are being delayed. NVIDIA delays rollout of China-focused AI chip report. NVIDIA is reporting delaying the rollout of the new artificial chip designed to comply with U.S. restrictions on X. They're trying to blame China for saying, oh, China just told us. I find it really hard to believe that China just waited for the holiday to come out with. So this is something that I'm having a real tough time in believing. And that level of credibility, I'm not the only cynic in the room. So you're going to have other investors that are just going to be like, I'm not buying this. Now, this is what bothered me about NVIDIA today. We broke the 12. So again, I use a 12, a 22, and a 50. I'm not saying the party's over. I just think that they lack credibility. And I think people are looking at this going, okay, so you got through the quarter, you said things were great, you're talking about the ramp up, and then what are you doing? You're coming out on a Friday, and everybody, if you're in the industry and you've traded for some time, you know that Friday is a news dump. You know this is what they do on Friday. They dump news, same way that they would do at the end of the day, but you actually have a bonus because the majority of people want in. You only do a third of your volume on days like that. So they know that, and that's what they're doing, and that's my opinion. Now, this is where it gets interesting. If we look at NVIDIA since earning, and we overlay ARM since earning, you're going to see a huge differentiation here. Since the ARM news that came out the morning of, and I'll show you that news in a second. What the heck was the news? The news was a note actually out of Goldman on how great this call was for ARM. And since you've had that call, NVIDIA is down 4.5%, 4.4, you can see right down here, and ARM is down here. Let's take a look. Now you can see the date right here, and you can see how this date coincides with this date and what time it is in the morning. So one of the things that I'm a big believer in, and I'll break out the stool in a minute and we'll walk through this for a couple of reasons. I'm a big believer in research. I'm a big believer in fundamental analysis. We don't spend an inordinate amount of time on it because the videos and that, but if you've been following this channel for some time, I literally read every research piece that is out there on Saturdays, and I read them all in the morning for my day even. So it's just the way that I was trained when I was growing up in the industry. I started on the sell side. So when I read this, this was glaring to me. So what they did, what Goldman did was they had, what is a positive read across? It means who benefited. There were two companies that benefited the most from NVIDIA's conference. What stood out was NVIDIA was not one of them. It was ARM and Microsoft. And this is what they had to say about ARM. We believe NVIDIA's stated expectation for ARM-based Grace CPU to become a multi-billion-dollar product reinforces our view that ARM technology will proliferate across a broader set end markets and applications over the medium to long term. Note that Microsoft also recently announced its first custom silicon built for the cloud, the Microsoft Azure Cobalt CPU based on ARM Neoverse CSS. Way above my pay grade. What I'm understanding is that positive read across is a nice way of saying this is better for NVIDIA, or better for ARM than for NVIDIA. Now, that allowed us to, when we knew that, to go out there and actually benefit from this and place a trade and get involved in ARM. And I like just showing the timestamp so that you can see this. Long ARM, short NVIDIA. And that's what we did at 9:45 at 11:22. I'm live trading, and then someone will be in the observation room typing this. So that's what we were doing there at that time. And the reason for that was not based upon technical, because if you're coming into the morning, you don't know yet. You think you know, but you don't. And I don't just mean you, I mean everyone. I mean myself included. So the one thing that is really important for us to wrap our heads around is there is macro, there is fundamental, and there is tech. And we're going to talk about macro, we're going to talk about fundamentals, and we're going to talk about technicals in a moment and how it relates to Argentina and why you need to be looking at Argentinian names. We've been talking about this for well over a week now, and we're going to really dive into it a little bit here on what names to look at. But what you need to take from what I'm laying down here is, based upon the fundamental research that I had, we knew that institutions were going to be leaning into ARM off the open. I'm not the only one that knows how to read through that document. Institutions know how to read through that document. That's how I learned. So they're looking at that fundamental side of the business, and that led to this obvious rally where everybody had to get in. And that gave us technical indications of where we should play it. Remember, fundamental is who, technical is when. But this is something that I want to be really clear about. These relative charts that I started utilizing here the past couple of weeks, gotten a lot of great comments on it. People are starting to implement these, whether they're in the community or not. This is what I want. You're implementing these into your daily strategy. I would strongly suggest that you do this. It is a game changer. If you're looking at 5 names intraday and you don't know what name you're supposed to be playing, and you overlay these names, your names, with the indexes, it's literally a game changer. It's a cheat code. And it allows you to make decisions so much quicker than everybody else. Now, the one country you should be looking at for investments is Argentina. They recently got a new president. He is extremely pro-business. Love him or hate him, he's going to deregulate everything, and he's going to push everything towards the US, the dollar, Bitcoin. He's going to deregulate everything. Let's explain what's going to happen. Right now you have a currency that is inflating, okay? And that is their peso. It is inflating, meaning it's going up. What is that doing? That is driving the cost of all their goods up, just like we had happen here. What we're having is we're having the dollar deflate now, and that is why you're seeing an alleviation of pricing. Some pricing is starting to alleviate. That is what Argentina is going to go through on steroids, because they are going to change their currency, this is what the president wants to do, to our currency, which is going to create one that was going up to one that is going down. That is going to allow them a couple things. Number one, it's going to allow them better pricing power globally because they're not going to have to worry about their currency keep going up and up and up. And this is when people are looking at what's going on with Japan. For us, people are traveling to Japan and going, wow, it's really cheap over here. Well, it's not that. It's the currency fluctuation. So Argentina is going to do a couple things. Number one, they are going to deregulate everything according to this guy. Number two, they're going to go to the dollar. Number three, they're going to start trading globally. What this is going to do to their banking industry and their energy industry is going to present all these markets that are going to cause it to rip. I'm doing a real basic analysis here. If you want me to do a more basic but broader analysis or a deeper analysis on what's really going on in Argentina, just put it in the comments. I'm doing the bare basics today so you can understand why we did a couple trades, and I want to show you a live trade. But we've been in this live trade for a while already because once this guy got in, we saw it coming. I'm not the only one that saw it coming. This was the move. We saw that move. But what I want you to understand is I want you to understand the basics of the trade. It is the decline of their currency. It is the deregulation that's going to drive this way higher than anybody thinks that it's going to. Okay, you have companies that are literally trading at like 4 or 5 times earnings that are about to go into growth cycles in a currency that is deflating. And if you take a look at what happens to the dollar, remember, as the dollar drops, the U.S. equities go up. Now picture the dollar dropping, but U.S. equities being priced at 4 or 5, and they're going into more markets globally. Okay, that's what could happen here. I'm giving you the basics. If you want me to go deep, like really deep into this, please comment below, and I'm more than happy to do it in a video coming up this week. And I think you should be going through all the names that are in holdings. What I'm going to do is I'm going to point out 2 that we're in, and I'm going to show you 1 live trade. The first one we're in is this bank. Now, we've been playing this for some time. But what you saw were people that didn't understand the stool. You must understand the stool. Now, where did these people make a mistake? And I want to say this so that you never make this mistake. They made a mistake in thinking the fundamental picture of the past, of what just happened, is the future of this company. This is a bank in Argentina. It's not their largest bank, but it is a bank, and it is one of the banks that I am 100% interested in playing. So we have a position in this. I think we're up about 20% in it at this point. I have to go and take a look at it. Let's call it 15, 17%. I think it's higher than that, but let's just call it that. Okay, so you have an entire macro shift going on there. The fundamentals of what happened when this was under a completely different type of administration, whether you like that kind of administration or you don't like that kind of administration, I don't care. Okay, what it does is it does stifle growth, and you might not care about that. That's okay. Bottom line is, if you want to own stocks, you don't want growth stifled. You want them to be able to flourish. Right now, deregulating everything, that's a conversation for another time. Doesn't mean that it's not going to have pitfalls, but before it has pitfalls, you have these companies that are out there sitting and they're rallying. So the people that sold this did not understand that these fundamentals are not future fundamentals. The entire banking system is going to change there. If you deregulate the industry, do you think JP Morgan and Goldman might be looking for new industries and new areas and new partnerships and where they could deploy capital and get outsized returns? Do you think they might want to do that with some of the local banks that have boots on the ground already? Just a thought, just something for you guys to think about in the back of your head. Do you think the energy companies like Exxon might be interested in one of the largest oil reserves in the world and one of the top oil reserves in Latin America? Maybe something for us to think about. There's the fundamental side. We start looking technically, and this is what's starting to happen. We're starting to see these moves. So this is something that we must understand, that it is the macro that is driving. The past fundamentals don't matter. Now, take a look at this. Reported earnings. You have a company that's earning 40 cents. We are earning 40 cents. I believe this one, they took a little kitchen sink quarter. I think they did that because they saw what was coming, so they threw everything under the bus. But you're supposed to earn 41 cents. If you go back to here, miraculously, they're earning 41 cents. This quarter, I think, was a kitchen sink, so they can take the write-off against the profitability they're going to have. But let's just go out there and say, and go out to this quarter as well, and go, that's 35 cents. So let's just go and go 35, 40, and 40, and come across, and then go 20, right? So you blend that out, and we're going to call it $1.20. Let's just say it's only it's $1.20 roughly, okay? Just going to blend it. It's actually higher, but we're going to call it $1.20. Stock's at 5. What are you trading times earnings right now? How many banks in this country are trading at these levels? Okay, and you can just keep going through them over and over again. Here's GGAL. Okay, here's another bank. This bank, I believe, is actually bigger. I'm still doing work on this. We own the other bank, but look at this. Look at this. $1.50. Okay, how about last quarter? 63 cents. So you start looking at this and going, these companies are trading at single-digit PEs, and they're about to go through probably their largest growth spurt that they've ever had. Is there risk associated with this? Yeah, there's a lot of risk, but there's also a lot of reward. YPF, this made 0 sense to me. We saw this rally up. We were actually trading it a little bit pre-market, but not a lot. We hit the ground running November 22nd or the 20th on this when we saw this start to kick in. Actually, it was on the 20th, and you can see it right here. I put the notes out in the morning, and you can see the names that we started looking at on the 20th. And you can see right here, they elected a new president. He's moving to the dollar. Expect the country's stocks to rally significantly. And these were the three that we looked at playing, and that was on the 20th. This is just John typing what we thought was going to happen. YPF, you might see straight buying. I was buying lemonade that day as well, and I bought a bunch of YPF at 9:35 on the 20th. We've just been buying it ever since, holding. And I'm just trying to be like really upfront here. Like if you're doing this as a day trade, you're going to hear it in the live trade in a minute. And this even on the 20th, if you're doing it for a day trade, you have to be pulling money out. And I'm just being really blunt, like I'm just going to keep adding to this thing because I think it's going to be a monster trade. And the more I looked into it, the more I liked it. And I started just explaining that. Let me find some of these charts and show you. So I just kept pointing out how it was doing, all the buying that was coming in. But the more you look into it, you start understanding what's going on there. Let me see if I can find this. Yeah, here we are again. Possible spot to add. I'm added, but I'm looking out longer term. It just kept building and building and building. And then I started getting into the books a little bit here. And you can see this is by 3:15. I really like this trade the more I look into it. That was the hourly, and we just kept adding. Now, what we're doing there is we're doing position building, and position building is a little bit different, and we can comment on that. The important takeaway for you, and what I think is important, is to understand that if you understand the macros and fundamentals of what's going on out there right now, you can do considerably well with these names. But I'm more than happy to get into more detail. I really want you to look at this pattern that we utilized this morning to buy more of this, and then listen to what I'm telling people and how I'm viewing everything. YPF, good. That's what I want to see. All right, YPF, they're finally going to catch on to. All right, I'm going to print more. I bought more YPF. I have no interest in selling that. If it takes out the low of the day, I'll close it. But other than that, I'm just not going to there. I want to own as much of that as possible. I'm going to have an overweight. The YPF is a good long-term idea. I don't know that that's the move. I think YPF, guys, if you did that for the trade, take the trade. Like I have no interest in doing that. I think that that's going to be, I think I've been pretty clear about that position there, that I think it's going to be an absolute monster. But, if you want it, just take it. You don't have to do what I'm doing. I think people are catching on. I think we're ahead with the YPF. Like, I think people are catching on the fact that they're going to be a player in the oil market. I actually think that Argentina is one of the reasons OPEC delayed. So if you're doing that for a day trade, you're probably going to want to, pull something out of it. I'm more looking at the longer term stuff here. The YPF made a ton of sense because we've been like stalking that, right, for some time. And I think people are catching on like, oh, hey, there's something going on here. Do you think? I mean, they have one of the largest oil reserves. That's why I put all that stuff out the other day, guys. Like they have one of the largest oil reserves. You most certainly are up $1. So at that point, you're definitely going to want to be able to, pull something out of that, guys. You're not going to want to sit there and not pull something out if you're doing this for the day trade. Just FYI, it could be a monster to percent. Again, I think you're up like probably $1.40, $1.50 on that trade. I'm doing nothing with it. We're so far ahead on that. I can't believe people didn't put that together. Boom, boom, boom. Here you go. Look at that. Just stay with it. Very little changes. Maybe it doesn't. Who knows? Go back to this. Get off the lesson. Let's go take a look at this. Straight up, guys. I mean, you're just going to have, let me go to basic here. And this is supposed to be plain. I wonder what that line's doing there. If you go here, you're going to see a ton of buying, right? Do you really want to be buying up here now? It's why we bought down here when it flipped because we had our level marked off. But you're up $2 on that trade, guys. So, if you're day trading, you're pulling money out of it. I've been pretty vocal that that's not what I'm doing. I'm not day trading it. Look, guys, before I go off on one of my other tangents, if you're up $2 on this, off that trade, and it was a day trade, I need to ask you why in God's name you're even still in this thing. Like there's literally no reason, before I go off on one of my tangents, there is literally no reason that you should still be in that trade if it's a day trade. Okay. You're over 90 on the RSI. You have a negative divergence and you're about to break the 7. All right. YPF, very simple what we did here. All right. We had a position from before. What we were waiting for it to do, as soon as we got over, we saw the volume. I really wasn't looking at that anchored VWAP, candidly, guys. I mean, I know it's in there, but I wasn't looking at that. I was watching my level because that's what I kept over again. So as soon as we flipped that strong bar, it's here. because this is really what we were using. That particular pattern, this is what I always say to people too, and they don't understand it. I care about the body. The body encapsulated that body. As soon as that body encapsulated that body, that means all the action, right? That's a bullish engulfing to me. People say, well, it didn't take out the wicks. Well, what do I care about what took out during a rejection? It rejected. What do I care about that, right? Wicks or what? Price rejection. I don't care. So once you flip there on my support or resistance is flipping to what? We opened there at a higher high. Made all the sense in the world because you had all this support in here. So that's why it was a great spot for us to buy it. And whether it was a day trade and you made $2 or you're still in it, remains to be seen. Now, for those that are still in it, okay, like myself, you gotta be cognizant of this, guys. Like that's a control bar and we're not breaking it. You are up 16% on your trade for the day. You might want to take it if it's a day trade for you. It is not a day trade for me. So I'm looking at it very differently. The big winner for us today was this YPF trade. We absolutely slaughtered it. It's up 16% today. And I think it's just literally beginning. One thing that I get a lot in these videos is that people think that I day trade. Yes, I do, but it's a portion of what I do. The majority of money that I've made has come from swing trading and long-term position building. And I really think that if you drill into this and if you want to learn more about this, I'm happy to do another video next week on it. Just let me know in the comments. That's it.